Okay, let's just dive right into this explainer. Today, we're mapping out the landscape of global digital finance. We're going to start way zoomed out at the massive macroeconomic scale, and then we're going to drill all the way down into the underlying smart contracts that actually make trustless digital cash possible. If you've ever found yourself wondering how exactly the crypto world manages to create its very own version of a stable US dollar without, actually using a traditional bank, well, you are in the exact right place. Hooking right into some recent data from JP Morgan, it's pretty clear the stablecoin market isn't just some niche experiment anymore. Just think about this explosive surge for a second. We are talking about a jump from just $3 billion in market capitalization back in 2019 to over $230 billion by the second quarter of 2025. That is literally exponential growth, the kind of growth that absolutely has traditional Wall Street taking notice. Now, before we get too deep into the complex plumbing of how all this money actually flows, let's just do a quick level set on our core subject. A stablecoin solves the massive, glaring problem of traditional cryptocurrencies like Bitcoin and Ethereum being, quite frankly, way too volatile for daily payments or predictable savings. It acts as a bridge. It's designed specifically to lock its value to a real-world asset, which is almost always the US dollar. So here's our roadmap for today's explainer. We'll cover the quest for stable crypto, how stablecoins keep their peg, look inside the DAI Stablecoin system, discuss surviving market crashes, explore spending crypto in real life, and finally, look at the broader macro financial impact. Starting off with Section 1, the quest for stable crypto and how they keep their peg. What's really fascinating here is how heavily this entire market is dominated by just a single design. Roughly 84% of the total market cap is held by fiat-collateralized coins. We're talking about giants like Tether and USDC. This means the vast majority of the digital dollars floating around out there are actually backed by physical dollars and government debt sitting in traditional centralized bank accounts. But as you probably know, not all stablecoins are built the same, so we really need to contrast these models. On one side, you have those centralized, fiat-backed models managed by private companies holding cash and T-bills. But on the flip side, we have decentralized, crypto-backed innovators like MakerDAO. Instead of cash in a bank, they back their tokens entirely with other crypto assets. And to make this work safely, they over-collateralize them to absorb those wild price swings. It's kind of like putting down a massive down payment on a house just to guarantee the loan. This brings up a brilliant analogy straight from the JP Morgan research. Managing a fiat stablecoin peg, it's actually remarkably similar to traditional fixed exchange rates, like the Hong Kong dollar. In both cases, the secret sauce to a successful peg isn't particularly glamorous. It relies entirely on maintaining market confidence to prevent a run dynamic, that nightmare scenario where everyone panics and tries to cash out all at once. You absolutely need a backing ratio over 100%, and you have to keep those assets highly liquid so you can honor mass redemptions immediately during stressful times. All right, moving into Section 2, inside the DAI Stablecoin system. The absolutely crucial point here is the CDP, the collateralized debt position. Think of this as the beating heart, the engine of the DAI ecosystem. You see, you don't just buy this digital cash, you actually mint it yourself. You deposit an asset, like Ethereum, into this smart contract, lock it up securely, and generate DAI against it. But because crypto is, crypto, meaning highly volatile, the system demands over-collateralization. You literally have to lock up significantly more value in Ethereum than the DAI you're taking out. Let's break this down into a practical 4-step cycle. Step 1, you deposit your collateral into a vault. Step 2, you generate your DAI, which essentially functions as a loan against your assets. Step 3, when you eventually want your collateral back, you pay down that generated debt along with a small, continuously accruing stability fee. And finally, Step 4, the smart contract unlocks your original crypto so you can withdraw the whole shebang. Which brings us to Section 3, surviving the market crashes. Now, that setup sounds pretty flawless in a raging bull market, right? But what happens when the highly volatile crypto collateral backing these loans suddenly just drops off a cliff? Are stablecoins actually stable? It's a completely fair, serious question to ask. Especially since the history of digital finance is just littered with depegging events triggered by confidence drops, smart contract exploits, or banking spillovers. Think about when USDC briefly dropped during the Silicon Valley Bank collapse, or the total catastrophic implosion of the Terra algorithmic stablecoin. So how does an algorithmic system actually survive a massive market panic? To protect the peg during severe shocks, MakerDAO relies on strict risk parameters coded right into the blockchain. If the value of your locked Ethereum drops a little too close to your generated DAI, boom, the system automatically liquidates your position, auctioning off the collateral to keep the whole system solvent. They also use what's called a target rate feedback mechanism. This is basically an algorithm that tweaks interest rates to dynamically balance supply and demand. If absolutely needed, they can dilute their own governance token to raise emergency cash. And as an absolute last resort, they can trigger a global settlement. That's a cryptographic emergency shutdown that guarantees users get the net value of their assets. Let's transition to Section 4, spending crypto in real life. Zooming back out to the real world for a second, let's talk about why all this complex, trustless digital money actually matters. Because, let's be honest, what good is a decentralized peg if you can't buy a cup of coffee with it? This is where the user experience is finally catching up to the technology. Platforms like Ubit are taking these complex DeFi instruments and turning them into highly practical tools. As investor Roger Ver pointed out, users can now take an asset like DAI and spend it seamlessly at over 150 million Visa merchants globally, right from their smartphone. The merchant gets their local fiat, and the user simply spends their stablecoin. By integrating with massive blockchain networks like BNB Chain and TON, stablecoins are essentially fulfilling the original foundational promise of cryptocurrency. They're acting as instant tap-and-pay digital cash. For the unbanked or for families living in countries dealing with hyperinflation who rely on stablecoins as a reliable store of value, this frictionless bridge to real-world spending isn't just some cool tech feature. It is a true game changer. Let's wrap things up with Section 5, the macro financial impact. We've looked at the underlying plumbing, and we've looked at the everyday retail consumer. Now we have to examine how this thriving ecosystem impacts the actual bedrock of traditional global finance. Here is a statistic that will probably drop your jaw. The stablecoin community is quietly becoming one of the most important buyers of U.S. government debt on the entire planet. They now hold roughly 3% of all outstanding short-tenor U.S. Treasury bills. Let that sink in. That is just under $200 billion locked up in T-bills to back these digital tokens. It transforms stablecoins into a legitimate macroeconomic force that traditional bond markets literally have to monitor. And here is the twist that surprises a lot of traditional financial analysts. Despite early fears that cryptocurrency was going to disrupt traditional sovereign currencies, it's actually doing the exact opposite. Because major stablecoins like Tether, USDC, and DAI are pegged directly to the greenback, JP Morgan notes that they actually extend and reinforce the US dollar's dominance across the digital realm. They've essentially created a frictionless, 24/7 global rail for the dollar. So, as blockchain technology seamlessly merges with our traditional capital markets, we are left with a massive, looming question. How exactly will the legacy financial system adapt to an always-on, programmable economy where banking hours simply no longer exist? It's a fundamental shift happening right now, block by block. Thanks for joining me for this explainer. Keep questioning the future of your money.